Welcome everybody. Hope you and your family is staying safe, healthy and strong. In this video, we are going to learn how to compute free cash flows, specifically using Excel. Let me tell you a brief about the free cash flow. In corporate finance, free cash flow is basically a way of looking at businesses' cash flows to see what is available for the distribution of all the cash among the security holders of the corporate entity. Free cash flow is the cash a company produces through its operation less the cost of expenditure on assets. In other words, we can say that the free cash flow is the cash left over after a company pays for its operating expenses and capital expenditures, which is also called as CapEx. So, let us discuss one numerical example and then we'll see how to compute the free cash flows. So, let me just share the example with you now. JL Production plans to launch new segment of business in IT consulting. The new segment will have annual revenue of $200,000 and operating expenses of $100,000. The annual depreciation and amortization for assets used in the business segment equals $25,000. An annual capital expenditure of the new business segment is $5,000 and additional working capital requirement will be $1,000. They have mentioned the marginal tax rate will be 35% and we have to calculate the annual free cash flow for the project. So in order to calculate the free cash flow, we have to use this format that is given over here. We'll begin with annual revenue. Annual revenue is the total amount of money made by the sales or the services in a given year before the cost or expenses are taken out. In this example, the annual revenue is $200,000. So, what you can do, we can write the amount. Let me just quickly drag it, or maybe I can increase the size a little bit so that it will be visible for you guys. Let us keep it 12. So the annual revenue is $200,000. And once we record that, we'll go to another item, that is operating expenses. We have to deduct the operating expenses from annual revenue. And what is operating expense? An operating expense, which is also called as operating expenditure or operational expense or operational expenditure, it is an ongoing cost for running a product, business or system. Its counterpart, a capital expenditure, is the cost of developing or providing non-consumable parts for the product or system. In this case, the amount of operating expenses is $100,000. So we have to enter data for the operating expenses, that is $100,000. And as you can see here, I have just simply deducted the operating expenses from the annual revenue, and that gives you $100,000 as EBITDA. So let me just quickly show you. You have to enter equal to, then click on the annual revenue minus the operating expenses, and that will give you the EBITDA. So when we talk about EBITDA, it is also called as earning before interest, taxes, depreciation and amortization. It is a measure of company's overall financial performance and is used as an alternative to simple earnings or net income in some circumstances. We can simply say that EBITDA is a measure of profitability. Then we have to deduct the annual depreciation and amortization from the EBITDA. There are two concepts, depreciation and amortization. Depreciation is an accounting method of allocating the cost of tangible. Remember, depreciation is charged for tangible assets. So it is an accounting method of allocating the cost of an tangible or physical asset over its useful life or life expectancy. Depreciation represents how much of an asset's value has been used up. Now in business, amortization refers to spreading payments over multiple periods. The term is used for two separate processes, like amortization of loans and amortization of assets. In the latter case, it refers to allocating the cost of an intangible asset over the period of time. So remember, depreciation is charged for tangible assets and amortization is charged for intangible assets. In this case, the amount of depreciation and amortization is $25,000. So we have to enter data for that. And you can see after deducting this depreciation and amortization, the amount left is $75,000, which is your EBIT. As you can see in the EBITDA, the depreciation and amortization was there. We have actually deducted the depreciation and amortization, and that gives you earning before interest and taxes of $75,000. We have to multiply the tax in case of this EBITDA. So for that, what we have to do, we have to multiply 1 minus T, or 1 minus tax rate. Tax rate is 35%. So 1 minus T will be your 65%, right? 1 minus this much. Let me again equal to 1 minus 35%. Then for finding out the NOPAT or net operating profit after tax, what we have done, we have multiplied the earning before interest and tax with 1 minus T, and that gives you the value of $48,750. Now again, we have to adjust for the depreciation and amortization by adding it back. So just enter the depreciation and amortization value. After that, you'll get the cash flow from operations. Okay, so what you have done, you have added the depreciation and amortization with NOPAT or net operating profit after tax, and that gave you the value of cash flow from operations. So remember, in corporate finance, net operating profit after tax or NOPAT is a company's after tax operating profit for all the investors, including the shareholders and the debt holders. And when you talk about the cash flow from operations, it's basically the cash which is generated from the normal operating process of a business, which is $73,750. From that, we have to deduct any kind of capital expenditure. Capital expenditure is also represented as CapEx. Now, capital expenditure is also called as CapEx, and these are the funds used by the company to acquire, upgrade, and maintain physical assets. And you can know all the properties, buildings, industrial plant, technology, equipment are the part of the capital expenditure. CapEx is often used to undertake the new projects or investments by the firm, making capital expenditures on the fixed assets that can include everything from repairing the roof of a building to purchasing a piece of equipment to building the brand new factory. So this type of financial outlay is also made by the companies to maintain or increase the scope of operations. Put differently, CapEx is any type of expense that a company capitalizes or shows on its balance sheet as an investment rather than on its income statement as an expenditure. Okay, and here they have mentioned the amount of capital expenditure is $5,000. So we have to enter that. Then deduct any kind of additional working capital. Working capital is the capital of the business which is used in its day-to-day operations, which is calculated as current assets minus current liabilities. Here, in this case, the working capital, the additional working capital is $1,000. And at the end, it will give you the free cash flow, which is $67,750. So remember, free cash flow measures a company's financial performance. Now, you can see that there is a positive value, right? Which is indicating a good signal about the company. Okay, so they have the free cash flow amount of $67,750. Well, that's all for today. Thanks for watching the video and checking my channel. Hopefully you got some value from the video. And if you get some value, please like this video and subscribe to this channel. And if you have any questions or suggestions, something that you like to see, feel free to comment below. And thank you very much for your time, for your attention, and for your commitment to learn more.